to Market Drop, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICIdirect. Very good afternoon, Pankaj, and welcome to the show.
Hi, good afternoon, Gitu.
Pankaj, what a volatile week it has been. On the positive side, we had budget which delivered both on capex and consumption front, and on the other side, we had hammering of Adani Group stocks on reports by Heidenberg, spoiling the market sentiment. What will it take to get the markets back on track, Pankaj, at the level of Nifty that you are closely watching at?
So, Gitu, if you look at it was truly a volatile week. So, Nifty traded in the range of say 17,200 to 18,000, kind of a broader band, and largely because of the selling pressure in Adani Group of stocks. Our sense is that since the markets have inched up closer to say 17,800 plus, and if these levels are sustained and possibly if we are able to sort of move or sustain beyond these 17,800 kind of a levels, then probably recovery in Nifty might accelerate. I think we've seen some bit of a recovery today, but overall, I think for sentiment to improve, I think we need to see further improvement in Nifty. I think the good part is that on two fronts. I think one was obviously on the budget side, there was a big anxiety related to long-term capital gains. So that did not pan out. And I think Fed policy was largely on expected lines. So they were not extremely hawkish. The rate hike was on expected lines, and which is why the volatility is sort of come down to near 15 kind of a levels. And most of the index heavyweight results are also sort of over. So from that perspective, I think overall our sense is that most of your big events are sort of behind us. And if you are sustaining above 17,800 kind of a levels, probably we will expect Nifty to sort of recover more. Globally, we are still sort of underperforming because we have seen Nasdaq sort of doing very well. They are at a 5-month high. But I think if markets hold these current levels, we would expect some respite in the market.
Let's talk about the budget for FY24. What are the key takeaways that you think should propel the markets higher and the economy growth figures that government has given for 6.5% for FY24? How is it really going to come over that numbers?
When we sort of look at overall from a budget perspective, it is more macro in nature. And I think one has to see the threads. So the way I see it is that one, the corporate tax, the government had already sort of pruned it down to globally competitive levels. Now, one of the big concerns always has been that the services part of the economy has always been sort of delivering for the economy, whereas the manufacturing has been sort of one pain area. Now, with China plus one kind of a strategy, I think logistic or infrastructure bottlenecks were expected to be corrected. In this budget, we have seen 33% higher allocation to infrastructure, and that too in two basic segments, which is road and railways. Mind you, in 2018, we were spending somewhere about 50,000 odd crores on both road and rail. Now you are spending 2.5 lakh crore each in both the items. So it's a nearly 5 times jump. So what the government is looking to correct is to lower the logistic cost, which is very important for manufacturing to sort of pick up. So which is where the maximum amount of focus of the government is coming in. So from that perspective, I think government is nailing the right areas. And I think the other thing is that CAD always has been an issue because we import a lot of things, and volatility in the input prices has implications. Now, to sort of correct that, government is also sort of taking measures. So one obviously is when you sort of look at from a key product. So for example, crude oil is one of the biggest import items. So for that, you are looking to sort of promote more of green hydrogen, which will lead to some bit of a replacement for that particular segment. Then I think we import a good amount of gold and diamond. So what the government is looking to do is promote more of lab-grown diamond. And in gold, what they have done is that the capital gains which accrues when somebody converts from physical to digital gold, I think that has been done away with. So that will lead to more of sourcing of gold domestically rather than sort of buying it from outside, and that is going to save us forex. And I think the other thing is that there has been some reduction in custom duty for essential items on the electronics part. That is another big import item. So I think from that perspective, government is nailing all the right structural problems faced by the economy. And so that way, I think budget has been sort of exceptional, according to me. It's sort of focusing on the right pain areas of the economy. So that way, I think budget, I really do not have much to complain. I think a good part also is that it did not contain any kind of a stimulus or populist measures. I think so that is another thing which is positive. I think tax tweaking will have marginal benefit, although overall consumption could benefit from that.
With no tinkering in the capital gains is the big relief for markets, and we saw market reacting post budget. But then Adani Group fiasco that is happening really took toll on the markets. Which are the sectors, Pankaj, that you think should benefit from the budget announcements?
So, capex spending, like I highlighted, has been the key focus area of the government. You are spending about 10 lakh crores, especially on road and railways and defense. So capex heavy or intensive sectors like bank, because you need banks to sort of lend them. Then you have traditional sectors like cement and steel. Typically, they grow in line with the GDP growth rate, bit higher when you are in a sort of a capex spending mode. And obviously infra and capital goods to sort of support or to make that happen. And logistic obviously is another sector which should benefit from this overall. So our sense is that when we sort of look at from a company perspective, L&T overall beneficiary, Siemens a strong product portfolio on the railways and automation side. You have bearing companies like SKF and Timken, which are leaders in industrial bearing and railway bearing market. And then you have players on the power side. I forgot to mention on the power side. So in power, what the government is looking to do is that since power is a state subject, so they have allowed the states to have a higher or an additional fiscal deficit of 0.5%, subject to their spending on power distribution reforms. So I think so that is another pain area for the economy, and which is why we feel that companies like KEC International or railway-oriented companies or something like Action Construction Equipment, which is a market leader in cranes, should benefit from this entire overall emerging opportunity.
Tourism sector has been given a healthy and a big boost in this budget. How do you see the stocks related to this sector doing?
So tourism is another sector which has the potential to sort of generate healthy employment. And mind you, when you're sort of spending, say, 50% of the overall capex in road and railways, obviously tourism is another sector which is a beneficiary of that, because you need that kind of infrastructure overall. And so from that perspective, tourism is another sector. We like the entire hospitality as a space. I mean, we've seen Indian hotels coming out with profits of nearly 400 crores, and something which they used to do on a yearly basis, what they have done in a particular quarter. And obviously, there are some tax exemptions, and also auto is another sector which should benefit, because you need heavy or medium commercial vehicles to sort of support all that kind of a growth. And which is why something like Ashok Leyland and Tata Motors are also expected to be a beneficiary of that.
Talking about the sectors which got hit because of budget announcements, one is insurance and the other is cigarette. But cigarette tax rise was just minimal, and we saw ITC doing well despite of the fact of a marginal increase in the taxes on the cigarettes. So how is that the insurance sector has reacted badly? What is the reason, and should you be a buyer at lower levels in this sector?
So insurance definitely is an impacted sector, because I think government has been sort of looking to sort of cap segments where HNIs have been using to sort of do investments. I mean, be it market-linked debentures or even the insurance policy, and which is why the government said that if the premium is over 5 lakh crores, 5 lakh, other than ULIP, so then tax exemption is not going to be applicable. And obviously, it will have implications, because HDFC Life has about 10 to 12% kind of a top line impact. And same is the case with others, probably in different proportion. The challenge is that if insurance segment was expecting a composite license, something which hasn't sort of really panned out. And I think this kind of a cap on high value insurance policy is negative. We don't expect any kind of a respite soon, because up till now we haven't seen that growth overall picking up for the sector. So all these stocks did well in the COVID and post-COVID because of high base. We haven't seen
Right.
much of a recovery, and I think which is why we would expect all these stocks to sort of remain on sidelines, and really do not expect and not bullish on them. Cigarette, I think when you sort of look at around results, ITC investors are always jittery that you'll see rate hikes being happening. This time also
Right.
the rate were hiked, but I think the impact is very minimal, because our sense is that the overall tax incidence will increase by say 7 to 12 paisa. So which means that companies like ITC can easily pass it on with a hike of say 1 to 3%, or probably they may not choose to pass on the hike also. I think good part is that the low price cigarettes, especially the 10 rupee priced cigarette stick, I think those have been sort of witnessing double digit growth, so which is good for ITC. And I think the hospitality as a segment is also having a positive rub-off. So all in all, I think it was a big or quite a good respite for ITC. We had seen initially negative reaction, and after that, the stock
Right.
has turned positive, and probably only FMCG stock, which is at 52-week high.
Pankaj, let's talk about the auto numbers for the January. How were the numbers pan out, and do you expect this kind of a momentum now picking up?
So last month numbers were soft because of the year end, people tend to sort of buy less vehicles. But now what we have seen is that we've been bullish on this auto space for quite some time, and month on month numbers have come out very good for PV, and I think tractor continues to remain a big positive surprise. On the PV side, we have seen good double-digit growth, especially coming from Maruti. UV portfolio for them has started to sort of fire. Tata Motors or even M&M numbers were quite good. I think CV, because the base was higher, so which is why we are seeing a probably single-digit kind of a decline month on month. But I don't think that's a sort of a worry. And in two-wheelers, largely the numbers were muted except for Eicher Motors, because premium segment has been sort of doing well. So the volumes were largely meeting expectation. Tractor is again, which continues to sort of surprise on a higher base. So both M&M and Escorts came out with good set of numbers. I think overall our sense is that the kind of pickup what we have seen should sustain over the next few months going forward, given the fact that the chip availability is sort of easing, and also I think the past challenges are also sort of behind us. So from that perspective, this is one segment which is looking good, both from company's perspective in terms of overall volume growth, in terms of better products being sold, and along with recouping of margins, which had sort of hit sometime low in the past 6 months. So I think things are looking quite brighter for one of the biggest discretionary categories, auto.
HDFC and Titan came out with their numbers this week. How were the numbers, and what is your strategy post Q3 earnings for both these companies?
So HDFC, I think largely merger is a bigger focus now. The numbers were quite good. I mean, the overall advance growth was about 12 odd percent. We have seen, like we have seen for most of the banks and NBFCs, the profitability was good. There was an improvement in margins, and the individual home loan segment did very well for them. And largely, I think they should be able to maintain ROAs of 2%. So number-wise, all good. I think the only hiccup is on the merger side. So from that perspective, I think that is the only clarity which is awaited. Otherwise, we are maintaining a buy on the stock. Titan numbers largely was guided by the management of 12% kind of a growth. The growth was 13%. So jewellery division did on quite good on expected lines. There was some bit of a margin pressure because I think since Titan is known for charging too much on the making charges, so they've been sort of providing some discounts there, and that is reflected in their margins. But I think good part is that whenever the gold prices rise, typically one gets worried about all these jewelry stocks. But Titan commentary, especially for the month of January, was quite healthy. So they are saying that sales were quite healthy despite the sharp run up in gold prices what we have seen. So that way, I think the demand momentum is quite good. So which is why we've seen Titan doing quite well in the markets today. So that way, I think Titan, despite all the negatives, I think did well relatively. And this is one stock with 30% growth, 7% market share, expected to take market share gains to further to 10 odd percent. So one of the only stock where we have comfort from a high PE stocks, generally what we see.
What are the major earnings that you would be eyeing for next week? I mean, which are the companies that will be announcing their results and are on your radar?
So I think major results next week, one obviously would be Tata Steel, because metal is one segment which has started to sort of buzz since the China reopening. So Tata Steel obviously numbers are expected to sort of be in focus. Now for Q3, what we expect is that you will see overall EBITDA per ton improving from say 10,100 to say 12,500. But that is largely because the coking coal prices have come down by $80, and while the realizations are also down, but the raw material prices have come down more, so which is why you'll see EBITDA per ton improve. I think what needs to be seen if the management guides that, and which is what we hope, that coking coal prices remain softer, and since the realizations have inched up because of China reopening, then Q4 is going to be a lot more better for Tata Steel. And if the management sort of confirms something on these lines, then our sense is that Tata Steel can sort of perform quite well. Bharti Airtel is another stock. So largely, I think we are expecting more of a sort of a muted kind of a quarter, 2% kind of a growth in ARPU, and wireless business also segment should see 2% growth. So from that perspective, it may not really provide the kind of momentum despite being an index-heavy stock.
Pankaj, I'm sure our viewers would love to hear from you on the group, which has been really quite volatile and people are concerned. So, what is your take on the recent fiasco that happened in the Adani Group companies?
So one is, see, we don't cover all the companies, but what we like within the Adani Group is Ambuja, ACC, and Adani Ports. Now, Ambuja, again, when you sort of look at from a valuation perspective, the valuation is quite low at about 11 times EV by EBITDA. I mean, typically, or cement stocks in general trade at about 16, 17 times for the size of, say, Ambuja. So from that perspective, it is looking very attractive to us, despite the fact that there are issues or market fears that there are issues with the owner. Similarly, even for ACC, it is trading below replacement cost of $135. It's trading below $100, trading at about 10 times EV by EBITDA. So I think both these stocks are looking very attractive from a valuation perspective, even before Adani had sort of picked up, or when you sort of compare with any of the cement existing stocks. And I think in Adani, it's at some 425, which is what we have done the calculation. I mean, we've seen this stock sort of declining 35% last 1 week. Now, there are number of positives which have sort of come in. One is when you sort of look at the free cash flow yield for this company is 8%. I think which is one of the highest what we have seen, debt to equity ratios and ROAN. So we really do not see any issues from a cash flow perspective for a company of this size. I mean, in fact, when you look at the January volume growth has been about 17% higher. So from that perspective, I think whatever news which we have picked up from a fundamental perspective has been positive for the stock. Hopefully, I think this kind of mayhem should not really derail should not further derail the stock, and our sense is that probably fundamentals will prevail, and probably we'll see stocks at better levels going forward.
Time for hidden gems. So, which is the stock that you're going to talk about today?
So I think capex is a flavor of the budget, and since markets are volatile, so I'm also sort of playing it a bit safe. So with that in perspective, I think L&T is one of the stocks what people can look at. Here our target price is about 2,795, offering about 30% upside. Now it is one of the best plays on the capex cycle. Company is well known, so it is the largest EPC company, and they've got various legs. and they operate in almost all the segments: infrastructure, heavy engineering, defense engineering, power, hydrocarbons. I mean, you name the segment they are into. And they have guided for an overall turnover growth of 15%, order inflow of 15%, revenue growth of 14 odd percent. And I think they're also addressing the green capex also. So they are investing about 1,500 crores in electrolyzer capacity in FY24. And I think we should see commencements of production in FY25-26. Along with that, they're focusing on monetization, especially of Hyderabad Metro. So all of them, or all of that monetization should lead to ROEs improving at 18%, which is now about 12-13 odd percent, both at a standalone level and also at the group level. I think the last quarter was also pretty good, because we know that the overall order inflow was quite good at about 21 odd percent. And a good part is that the overall ordering to tendering ratio is improving. So it's at about 52% compared to that 48% previously, what we have seen in the last 9 months. And obviously, icing on the cake is the budget hike of 33% in the overall capex allocation of 10 lakh crores. So I think L&T is one of the best proxy plays to sort of play that kind of an opportunity. So which is why our target is 2,795, offering 30% upside.
So hidden gem for this week is L&T for 30% upside. Pankaj, major events are over. Your budget is over. Your FOMC meeting is over. Your earnings are getting over. So what is that you will be watching out for next week? Adani gyrations are there. They will be addressed by next week. So what will you do? What will your strategy be like?
So I think what everyone, and I also want, is that markets should stabilize at current levels, because most of our big events are behind us, be it US Fed policy or the budget. So all your bigger anxieties are sort of behind us. And I think most of the bigger companies have already sort of come out, or index-heavy companies have already come out with numbers. So I think overall stability is what we expect. And I think if markets sustain these levels of 17,800, then we would expect further recovery to sort of pan out. I think that is the only crucial most thing which we are sort of watching out. I think all things are in sight to sort of market to sort of recover. Let's see does that happens next week, and hopefully volatility in some of the Adani stocks also could subside. So from that perspective, I think we are hoping that there will be some stability in the market next week.
Thank you so much, Pankaj, for your time. Pleasure speaking with you.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICIdirect.